Chapter 8 now, pricing. We're talking about how a company sets its price. Now, in this chapter, we're only going to be concerned about 1 and 2 here. We're not going to look at time and material pricing. We will talk in class about transfer pricing. You should at least be aware about transfer pricing. But mainly, we're going to talk about target cost, how we set the the market. In the first case, the market sets the selling price. We determine whether we can produce it within a certain cost range in order to compete. In the second case, we set the selling price, and that's based on how much it costs us plus how much we want in terms of a return on our investment. Pricing goods for external sales. Now, this is affected by many factors. Of course, it's the environment, the political environment, the economic environment within which we are operating at the moment. Every business has to be aware of its environment. Then it also has to be aware of the market, okay, who our competition is. We have to gain market share. So our objective here is to set a selling price that will not only give us a piece of the market, but will also give us a rate of return. We have to be profitable. Economics comes into play. What's the demand and supply, the demographics of our market, and so on. These are the subjects of other courses. In this case, we are talking here about the cost considerations, fixed and variable costs, short-run costs, long-run costs. Because it says here is regardless of the factors involved, the price must cover the cost of the goods or service. We have to cover that before we can even begin to earn a profit. So therefore, to repeat, a company must have a good understanding of its market forces. Where we have a product that is not easily distinguishable, differentiated from our customer, different from our customer, then basically prices are not set by the company, but rather by the supply and demand. And we, in this kind of market, our company is called a price taker. Somebody else has set the price. If I produce a product that's similar to somebody else and it's selling for 10, well, therefore, I'm going to have to sell for 10. I can't ask for more. I can't ask for more because my product is no different, no better. All right, so when products are unique or clearly distinguishable from each other, like Apple's products, then they can set their own price. They don't have to be a price taker. So what you have when you're in this kind of a market is this. You look at the supply and demand for that product at that particular price. To earn a profit, then you must focus on producing that product within and selling it for that price. Therefore, the key thing is to control costs. And how well controlled you can control the costs will end up with your desired profit. So, an example here, target costing. What we say here is, okay, we know what the market price is. We know what kind of profit we want to get. We subtract it from the market price, and the question is, can we produce and sell this product at that target cost? First, the company must identify the market and know it very well. Second, it conducts market research to determine what the target price is. The market is determining what the price is. If our price is too high, we simply won't sell. Third, the company determines if that target cost or what that target cost should be, and it sets a desired profit. Let's go through an example. Fine Line Phones is considering introducing a fashion cover for its phones. Market research indicates that 200,000 units can be sold if the price is no more than 20. If Fine Lines decides to produce this cover, it knows that it must invest $1 million in new production equipment. So there's your fixed costs. Fine Line requires a minimum rate of return of 25. So that's your ROI, return on investment. That's my profit that I want. So determine the target cost. Well, let's get the profit first. I'm going to have to invest $1 million to do this thing. I want 25% return, so therefore I want a profit of $250,000. So each cover, there's 200,000 covers. So each cover must give me a profit of $1.25. Now, we look at the market price, which is 20. And we say, okay, we need a profit of $1.25. The question now becomes, can I produce this product for $18.75? Produce it, market it, sell it, and everything else for $18.75. Well, then I look at the variable costs, and I know the fixed costs. The fixed costs are $1 million. Okay, so then I set the price based on that. In an environment where there's little or no competition, I have a very unique product. The company then can sell it product at its own price. It can determine its price. And so therefore, we look at what it costs us to produce this. Then we add on the kind of profit we've got, and we end up with a target selling price. So it's cost plus markup. And it's as simple as that. In determining the markup, the company must consider the competition and market conditions. The ROI is the net income divided by the invested assets. And so the selling price minus the cost gives me my markup. And an example, therefore, ThinkMore is in the process of setting a selling price for its new video camera pen. It's a functioning pen that will record up to 2 hours of audio and video. The per unit variable cost estimates for the camera are this: direct material, 23, direct labor, variable overhead, variable selling and admin, total cost, variable 60. All right. In addition, it has the following fixed costs per unit. Now, the fixed cost, $280,000, and manufacturing costs. And if we do a volume of 10,000, it's going to be 28 per unit. The fixed selling and min, 240, and if we do a volume of 10,000, it's going to be 24. So based on a volume of 10,000, we say that the fixed cost per unit is going to be $52. So therefore, ThinkMore has decided to price its new video camera to earn a 20% return on investment. So the markup is 20% of the ROI of the 1 million. So therefore, the expected ROI is going to be 200,000. The variable cost 60, fixed cost 52, total cost 112. And what we want is a markup of 20 based on, and then therefore our selling price would be 132. And that's the cost plus pricing method. Use the markup to set the selling price, compute the percentage desired, 20%, total cost, if you want to look at it that way. My markup percentage is 17.86 on my total cost. So total unit cost is 112. Therefore, my profit is 17.86 of 112. My selling price is 132. So there's the two methods. You look at the cost price method, and we also look at the target cost method.